Now we go to today's topic, reform and opening up of the Chinese financial markets. As our agenda suggests, in the background of head-to-head competition between America and China in trade and technology, China's financial opening up could be one of the very few bright spots. That doesn't mean there will not be tensions or disputes, though, such as the accounting incidents involving Chinese companies listed overseas. So opportunities and challenges both lie ahead. What are they, and how to navigate through these unusual times? Today we have three speakers. Michael Chen, Managing Director of Head of Overseas Client Service, China Central Depository and Clearing, or CCDC. Peng Qinqin, Senior Reporter of the Finance Team at Caixin Media, and Thomas Schaffner, Portfolio Manager at Vontobel Asset Management. They will each have a 5-minute presentation before we go to Q&As. First, we'll have Thomas, who deals with Chinese equities, and before joining Vontobel, he has worked in Hong Kong for years at Lombard Odier. So he knows China market well, and he knows what the international investors are interested in. Thomas, please go ahead.
Okay, thank you very much for your time and your kind words. I want to give you a quick introduction into Chinese equity markets, because there's not like one single big market, but actually there are a lot of different subsegments. So first of all, to put things into perspective. So here we actually see the equity market cap of the major global markets, as well as the trading volume. And as you can see here, China is already the second largest market in terms of market cap. And on the right-hand side, it's also the second largest globally in terms of daily trading turnover. However, I have to add here, depending on the day you look at, China actually in terms of trading volume is already the most liquid market globally. And of course, that makes a market interesting for institutional investors like us, because when you look what the Chinese market has to offer, is it has to offer a lot of growth, because China is still growing above average, the global growth rate. Also, the market is relatively broad, so you have a large selection of companies you can choose from, and the market is highly liquid also. And what's also special to China is you have a very high retail participation, so retail investors make up to 80% of trading participation in the market, which means the market might not always be that efficient, which gives room for bottom-up stock selectors like us to identify interesting companies. I have prepared an overview of the major listing places for Chinese equities. And basically, historically, there were like two venues. So there were like offshore listings and there were onshore listings in mainland China. And the reason for that separation is that the capital account of China is only partially open, so capital can still not move freely. So you have like these two separations. Now, with the opening of China and the further financial liberalization, the lines are blurring. So it's becoming possible for us to invest in onshore Chinese A shares, but it's also possible for Chinese investors to invest overseas at the moment. When you look at the major trading places, then you have Hong Kong, where a lot of Chinese equities are listed. Example of the largest names there are Tencent, Meituan, or China Construction Bank. A few of these stocks actually are listed in both markets. So for example, China Construction Bank is listed in Hong Kong as well as mainland China. The second venue, and that's the venue currently to a lot of hot political debate and pressure at the moment, are ADRs in the US. So examples would be Alibaba, NetEase, or Baidu. And the third, we call it others here, or like smaller locations, like for example, Singapore or London or Germany, where also a few companies are listed. But Hong Kong and the US are clearly the most important venues overseas. Then the question obviously is, why did the companies list in the US in the first place? The reason is relatively simple, that initially the US had a very broad investor base, a lot of capital, but also a lot of tech-savvy investors initially. So that made the listing for companies in the tech space easier in the US. However, all this has changed in the meantime, and China is the second most liquid market. Hong Kong is also highly liquid, has a lot of tech listing. So it's no longer actually necessary that these companies list in the US. And that's actually one of the big trends I think we're going to talk also further about today, is the so-called homecoming of Chinese ADRs to Hong Kong or to one of the stock exchanges in mainland China. One reason initially also for companies like Alibaba to list in the US was that Hong Kong did not allow so-called weighted voting rights, which means you have like two share classes and one share class has a higher voting right. By that structure, it allowed management or the founders, by holding like a small amount of capital, to actually control all the voting rights. And Alibaba was such a case. However, Hong Kong has adjusted the listing rules, so these companies also can list in Hong Kong. That's not something special to Alibaba or other Chinese tech names. Companies like Google, for example, or Facebook have a similar structure. One advantage of listing in the US is still that it's cheaper to trade. So in Hong Kong, you have to pay a relatively high stamp duty, which you don't pay in the US. So trading liquidity as a result of that is higher in the US. So when you look at Alibaba, for example, daily trading volume has been 3.7 billion compared to 600 million in Hong Kong. However, I mean, these numbers are huge, and you only find very few stocks globally outside the US which have such a high trading volume like Alibaba has in Hong Kong. And then when you look at the right-hand side, you find the onshore A shares in mainland China. So you have the two exchanges of Shanghai and Shenzhen. And then you have the main board. And in Shanghai, you have the Star Board. And in Shenzhen, you have the Qinqin board, which is the board to list like more venture capital, high growth companies. These two boards have been relatively successful, and companies there trade at very high multiples. Examples of domestically listed shares would be like Mutai, which I think by now is also a very popular name in the West, Peng and China Merchants Bank in Shanghai. The later two are also listed in Hong Kong, while in Shenzhen you have Wulangye, which is not a liquid name, or consumer names like Midea and Gree. For me, as like
Thomas,
a global...
We have to speed up a little bit. We can leave more time for Q&As. Yes, please.
Yeah, no, I will be fast. Don't worry.
Okay.
For us as global emerging market investors, the interesting part of China actually is the consumer area, the healthcare area, or the industrial area, where we do not find that much of a broad range of selection which we have globally. Here for you, just to give you an overview of all the stocks which are available, because people often don't know what it actually means. Very broadly speaking, you have the A shares, which are the names listed in mainland China, and you have like the H shares, red chips, and P shares, which are the names listed in Hong Kong. The details are technical in nature, so you can read it out here on the slide, and the ADRs, which are the names listed in the US. And that's actually the second biggest trend which is happening now, the opening of the mainland Chinese market to overseas investors through Stock Connect, and the opening of the Hong Kong market to mainland Chinese investors also through Stock Connect. Initially, you could not invest in Chinese A shares as a foreign investor, That was later liberalized through the so-called QFII and RQFI schemes, where you basically had to apply for a quota, and then you could invest in Chinese A shares. And now the next step is the Hong Kong, Shanghai, and Hong Kong Stock Connect, which is actually relatively easy for us to invest in mainland China. One important thing here is to notice that you have to be included. So not all names listed on the exchange are included in the scheme. And at the moment, the big debate is about Alibaba, because Alibaba already listed their ADRs successfully in Hong Kong, but it's not part of Stock Connect yet. So if Alibaba is included in Stock Connect, that could be another major milestone in the opening up of the Chinese equity markets.
All right.
Thank you.
Thank you, Thomas, for the overview of the stock market and categorizing the different sections and products. Next, we will turn to Michael. You may know that CCDC provides central registration, depository, and settlement services. And Michael is at the forefront of dealing with international clients. And before CCDC, he worked for HSBC, Standard Chartered, and JP Morgan. So he knows both the regulators and the investors. Michael, please.
Okay, thanks, Zengxin, and very glad to be here. The event co-hosted by Caixin and Asia Society. I come from CCDC, which is the abbreviation of China Central Depository Company. We are like Euroclear in China. We are the key financial infrastructure here with about 80% of market share of China's bond market. And because we deposited all the China government bond, local government bond, and financial bonds, so about 95% of overseas investors' bond holding are deposited with us. So today I just want to give a very quick overview of China's bond market opening up, and later on I'm glad to share more views from local CSD perspective. From the left chart, you can see China from 2018 year end, we are the second largest bond market in the world. We surpass Japan as the second largest. And in the right chart, you can see, although we are the second largest, but the upside room is still very huge. We use the debt securitization outstanding divided by GDP amount. We see China is less than 100%, but for the developing countries like UK, US, Japan, all above 200%. So we still have very large upside. Here is the left chart, just give you some market structure. In China, the bond market, we have two major markets, the CIBM, China Interbank Bond Market, and Exchange Market. These two markets are regulated by different regulators. CIBM is about 80% of market share. It's regulated by PBOC, Central Bank. And Exchange Market is quite small, focused on the retail investor, regulated by CSRC, China Security Regulation Commission. So it's different two systems. CCDC, we are the key bond depository in CIBM market. It's like a wholesale market. We are the depository, as I mentioned. We are the like Clearstream or Euroclear's role in China. And the trading platform, there is one uniform trading platform in China, which is CFET, China Foreign Exchange Trading Platform. So it's kind of, you can like China's Bloomberg or TradeWeb. But China, all the trading is doing by CFAX, but different bonds are deposited in different depository center. So CCDC, we focus on government bonds and the financial bonds. So we are proud that because of we are the leading player, so we about we just contribute about 80% of the China's interbank market. So it's just the timeline of China's bond market opening up. Before 2016, the opening up is just step by step, very slow and on pilot basis. But 2016, it's a milestone in China's bond market opening up. PBOC announced all the overseas qualified investors, they can filing and they can select a local settlement agent bank, so they can access without a quota. So for the bond market, we are very proud to say that it's very, very open, even more open than the equity market, because equity market, before the launch of StockNet, you have QFII, RQFII, and it's quota basis. But the bond market from 2016, so no quota. If you're filing, you can invest as much as you can, and you can exchange for CNY here and do hedging based on your actual needs. And another milestone is the last year, 2019, and the inclusion of the Bloomberg Barclay Index, and follow on the JP Morgan Index also follow up. And in the September, we are very keen to see FTSE, FTSE Russell may also include China's bond. So I think it's another milestone of the globalization of China's bond market, because it's widely recognized by overseas investors after a series of efforts from our regulators and market players. And this is the summary of opening up regulations in the last 12 months. I don't want to repeat here, but you can see the PBOC, SAFE, the Ministry of Finance, and also the CSRC, as well as CCDC, put up a lot of efforts, new regulations, new initiatives to facilitate the access of overseas investors to this second largest market in the world. And we are very glad to see that in the second quarter of this year, there are 420 billion renminbi capital inflow to China's security capital markets, within which I think 250 billion renminbi is from bond market. So we see total, I think it's about 60 billion US dollar, a 6 billion US dollar capital inflow, and 60% is from bond market and 40% of equity market. I mean, this is the net capital inflow from overseas investors in just 1 quarter this year. Just want to share with you, besides the BankNet, which you may be very familiar with, there's another major investment channel which we call CIBM Direct. So there are 2 major channels. CIBM Direct, in short, is just an overseas investor open an onshore account, so they can like a direct flight. And BankNet, you connect, you transit in Hong Kong and fly to China. It's kind of a transit flight, a connecting flight. So they are focused on different clients. In short, CIBM focus on large, in-depth investors, sophisticated investors, so they can have more investment products, investment scope, lower cost. BankNet, they may be more easier to apply, but they can have very limited investment scope like StockNet, and they are not allowed to invest in full products and with full market participants. So in terms of the overseas investor, we see 85% of overseas investor depository are from CIBM Direct. Majority of them are central banks, sovereign funds, as well as a lot of leading asset managers. A lot of investors, especially small, medium-sized, and also hedging funds, asset managers, they are also proactively join the CIBM market by BankNet. I think these 2 channels are kind of have different proposition, and so I think they are working very well. And in terms of the total deposited volume, we are very glad to share with you that 95% of overseas investors are deposited with us, And I think 70% of them are investing in central government bonds, and also some of them invest in local government bonds. And also the rest of them invest in the financial, the kind of policy bank bonds. So last page, just very quickly go through some future develop trends with you. So I think the first is the transit of a bond settlement agent role from the transition from the local bond settlement agent bank to the custodian bank. So it's kind of on the agenda of the regulator to give the local banks more business opportunities, as well as give them more the frontline duties on due diligence. The second, I think, is to facilitate more asset managers, their products to participate. So once the manager filing them, so their products don't need to file again. And also opening of bond future markets. As you know, the onshore banks and insurance company are allowed to invest in bond future markets already. So next step, we are very keen to see the overseas investor, maybe from central bank, can access this market. And also the opening of primary market. I think this is a huge market. Overseas investor less tap in, but I think it's very, very interesting topic we can further discuss with you. And also the fungibility between BankNet and the CIBM, especially once you fighting with one scheme, you can try another scheme very quickly. I think this is also in the consideration of the regulator. And also the last is enable electronic trading, especially TradeWeb, Loanbook, IFQ trading, and the CIBM Direct. This trading mechanism is piloted very successfully on the BankNet. So I think the onshore regulator very most likely may release to replicate to CIBM Direct. So we are very keen to see this happen very shortly. So I think this is all from my sharing, and look forward to share with you more in the Q&A section. Thank you.
All right. Thank you, Michael, for letting us know the policies and developments in the bond market. Next, we will have my colleague Qinqin. Her specialty includes monetary policy and banking. She was leading a lot of exclusive interviews with the PBOC, CBIRC, and cover stories on China's lending market and debt. Qinqin, your turn.
Thank you, Zengxin, and good afternoon for the people from Europe, and good evening from China. My name is Qinqin Peng. I'm a reporter from Caixin Media. I'm covering Chinese Central Bank PBOC and all the issues PBOC is overseeing, including the opening up of the financial market, because that's PBOC is leading it. So Michael and Thomas gave a brief introduction about the capital markets opening up, and Zengxin asked me to be more focused on the FDI part, the foreign investors shareholding of financial institutions. So first of all, I'd like to say that I think China's opening up is a process of step by step. So we all know that in 1979, China launched the reform and opening up, and I will call it the first round of the opening up that makes a massive change from zero to something. And in 2001, after the accession to WTO, we started the second round of opening up. And now we are at the third round of opening up, which started from 2017. And the round is aimed at lifting the ownership limits on financial institutions. And that's what I will talk about later. In 2017, China has removed the ownership caps on banks. So now a foreign bank can hold up to 51% in a domestic bank. And at the same time, according to the Chinese banking regulator, the past 2 years have seen 34 policies implemented that relate to greater openness in the banking and insurance sectors, which is quite a great step for Chinese financial market. And last year, we saw 11 significant new measures aimed at opening up China's financial sector to foreign investment. So we call it 11 measures. So in this new 11 measures, if we implement the 11 measures, we can see China will lower the barriers to enter for foreign capitals, and that will result in the issuance of more licenses to foreign firms and raise the shareholding upper limit for foreigners. So in April this year, we see that China just removed the limitation on the ratio of the foreign shareholding in securities and fund management firms. So now China is allowing full foreign ownership of life insurers, futures, mutual fund companies, and the foreign ownership caps for security firms came off in April. And foreign companies can now be lead underwriters for all types of bonds and can control wealth management firms, pension fund managers, and inter-dealer brokers. So we are now seeing a lot of big names having dived in, like BlackRock has applied to set up a wholly owned mutual fund firms, and Vanguard told the regulators they intend to apply for license. And JP Morgan has already taken majority control of China-based mutual fund, a joint venture, earlier this month. And late July, we heard from PBOC that China will adopt a negative list for future finance open up associated with free trade agreements. So we can see that all the efforts that China has been doing is to remove the ownership restrictions. But it has been proven that over the past 10 years, that ownership restrictions are not the biggest constraints for foreign firms to grow in China. Because I'm a journalist, so I will be a little critical to all the issues. So now I will talk more about the challenges that the foreign firms would face in China. So we say that it's easy to enter, but not that easy to survive in China. Why? So first of all, it's about the equal treatment. Actually, we can safely say that the most of the foreign financial institutions are equally treated in China, but they are equally treated as a private sector. Because you know that in China, the financial market is dominated by the banks, and the banks are dominated by state-owned companies. So we think, or say people's concern is that the foreign companies will have a similar implicit barriers with the private companies as well. So, and also they have the challenge to crack a market dominated by government control rivals that have long-standing relationships with the clients. So that's the first challenge the foreign firms will have in China. And the second is the challenge of localization. So it's urgent for foreign institutions to adapt to China's local environment. So everything needs to be locally tailored, including risk control, compliance, and network securities, which is very challenging for the foreign firms as we learn from them. And the third is the art of talking to the government, including the central government and local governments. So if you have experience of doing business in China, you will know that the central government and local governments have different ways of thinking. So I'd say to treat local government as like to treat the corporates. So once they are convinced that your investment is beneficial for the local government economy, they will do their best to give you the green light. So it is a crucial part here to convince them. So here comes the fourth challenge, that is to find a qualified talents like Michael, right? So the people are not only required to understand the foreign culture and languages, but also know the Chinese market well. But now, as we know that returning this kind of talent is close to impossible now in China, because now the foreign financial institutions are not that attractive as it was before, because now the top Chinese executives are more likely to set out to their own rather than settle for the pay packages offered by the foreign institutions. So those are the challenges I think the foreign institutions may have in China. But we also have to say that Chinese market is very promising, and cracking a largely unknown market will never be easy. So I just want to add more perspective about the whole issue, and which those will be helpful for you.
Thank you, Qinqin, for pointing out the reality, which is the limitation of being treated equally. Now we come to Q&A. I will ask a few questions first. For our participants today, you can submit your questions by clicking the Q&A button. And if you do like, you can even raise your hand to speak to the speakers in person. Now I already got some questions. First, I think is for Thomas. Why should companies want to list in China?
Yes, I think it's relatively simple. You have different investor base in mainland China compared to abroad, but at the moment you can probably get a higher valuation if you sell your business or if you list your business in mainland China compared to the US or in Hong Kong.
Our next from the participants to Michael, how do you foresee the relevance of Hong Kong and Macau as China mainland advance with the financial market opening up?
I think China, they are, because both of them are part of China, right? So I think they will play a very unique and important role in the market opening up. For example, in Hong Kong, the legal system, the way of doing business is Western-like, but it's also very, very close to China capital market. So I think this is their unique advantage. So I think they also, as well as Macau, I think Hong Kong is kind of legal system is different from Macau. So I think especially in the One Belt, One Road initiative, Macau can also do a lot of things because the legal system is more connected with the European countries. So I think they are very unique. So I think even going forward, the central government will make full use of these two gateways for overseas investors to better access.
Next question is from me, goes to Thomas. As in your presentation, you said that there are many products that international investors can make trade in, but Qinqin also said that there are also obstacles of localization and things. So in your view, are these developments or are these measures enough? And further, what's the end game for China's financial market opening up? What's the ultimate goal from an investor perspective?
Yeah, I think the end goal will be a complete opening up, and that there will be no more differentiation between like H shares or A shares, and that all stocks will be freely tradable and fungible. But I don't know whether this is a question of 5 or 20 years.
Okay. Next question goes to Qinqin. Can you take just give some more examples about localization and persuading get the local governments involved?
Yeah, here's one example I think which is very interesting. So that foreign investors are very interested in Chinese non-performing loans (NPL) markets, and China has already agreed to allow U.S. financial services firms to apply for the asset management company license (AMS) license. And that the license would allow them to acquire NPL portfolio directly from Chinese banks. So we heard that there's a news saying that Oaktree has already become the first foreign company to set up the only unit in China as an AMC company. But which I think the news is not very accurate because Oaktree's unit in China is not a AMC. According to Chinese law, every province can have up to 2 local AMCs, and China has 31 provinces. But the developed provinces, the name you can recall, like Beijing, Shanghai, and Guangdong, they have already set up 2 local AMCs. So there's no room for them to have more. So how about the remote provinces like Gansu, Ningxia? The local AMCs are only allowed to do business within the province. And so the foreign firms may not be aware of how to do business within those remote provinces. So I think this AMC is a very interesting example here to see that the difference of allowing them to do and how they can do that.
Our next question goes to Michael. As you said, the government has already released various policies and measures to attract longer-term investors. My question is, how are they implemented these measures and policies? And also, can you talk more on future plans?
I think compared to 10 years ago, in terms of overseas investor, 10 years ago, we only have 6 overseas investors at CCDC, 6. But currently, how much we have? We have 1,200. So I think you can see the dramatic achievement. And also, especially in the reserve management area, we just received a report. So the total global reserve management, 2% is allocated to China already. I think part of them equity, part of them to the bond, but I think a majority should be in the bond area. But we can see there's still upside, because I think in the SDR basket, the renminbi proportion is 10%. I think it's about 10%. But currently, in the global settlement, renminbi is 10%. In the global reserve management, it's 2%. So I think we still have a very, very large upside room to develop. So we estimate such kind of percentage may go up to maybe 5% in maybe next 3 to 5 years, especially after the 3 major bond index inclusion, as well as more opening of China's bond market. Especially, I think more and more opening of the financial market, as Qinqin mentioned, more overseas issuer, more overseas investor, as well as more overseas credit rating vendor, and also a lot of custodian banks, service provider will join. So they will bring more and more overseas investor capital flows. So going forward, I think the regulator, I think they have more initiative to implement long-term investors. But I think from 3 categories they are working on, as far as I know. The first, I think they may further to streamline, to simplify, or to optimize the access channel. Currently, we have BankNet, we have CIBM Direct. We don't want to have any more, but how to merge them together, how to merge them with QFI, RQFI. Once the bond investor, they are doing bond investment, but they are also like to do the bond future. So they don't need to go to filing for QFI, RQFI. They can just do with their kind of filing with PBOC. So they can also do bond future, which is regulated by CSRC. So I think this is something I think a regulator is also thinking about. The second, I think, is to further adopt to global standards. The global standards, not only to the trading platform, not only to the custodian and the custodian protocol, as well as to the credit rating. I think S&P already have presence here. They are doing business here locally, and also Fitch and also Moody's are also joining us. So I think in the information disclosure, we are also very proactive to leading the such kind of information. I recently met with some guys from Tencent. They are working on to use the fintech to improve the information disclosure of retail ABS. So I think in this area, China is the leading in the world. So you can use the Tencent big data to see the repayment of even each individual. So I think this is also something we are leading. And the third, I think, is the further open derivative markets. Like it's not onshore, but it's also offshore. So once we have the onshore bond future open to overseas market, why not we can have the overseas overseas exchange house listing offshore bond futures? Like I think Hong Kong Stock Exchange had already have some pilot trial, but I think it's not go live for a long time. But I think when 2 or 3 years later, it maybe happen. So once that happen, it will also bring in more hedge funds, more liquidity to the market. So I think this is the roadmap for next 3 to 5 years.
Well, a lot of information here, and thank you for bringing up global standards. That makes us believe that the global system is not breaking completely yet. And also, Michael mentioned information disclosure, and we have a question from our audience. I think this goes to Thomas. Should we expect the ADR homecoming phenomenon to lead to temporary market anomalies and investment opportunities, please?
Yes, that's actually a very good question. I think it depends. So whether the homecoming is forced. So for example, the US would delist all the Chinese ADRs immediately. Of course, that would lead to some uncertainty and some volatility in the market, or whether it's a gradual process from stocks moving from the US to Hong Kong, like now happened with NetEase or with Alibaba. What we can observe also is that in Hong Kong, you tend to get higher valuation. So stocks which move their listing from the US to Hong Kong actually moved up. And then another obviously important point is whether these names would be included in Stock Connect, which would then broaden also the investor base.
Our next question is to Michael again. How do you see the existing stage of MOX and Macau tight capital market for issuers from abroad? When do you expect that the new regulation for foreigners bond issuers in Macau capital market will be available?
I think Macau, we work very close with MOX because we signed a strategic partnership with them. I think in the last July, I think they issued the first central government bond issuance in the Macau. So we are very proud to participate, provide support. Because in the China market, all the central government bonds are issuance in our venue. So I think in that landmark deal, we also provide assistance and also a lot of support. I think Macau, the financial market is developing. So it may not that quick to replace Hong Kong's role. But I think, China, once the central government wants to develop, it's something will happen very quickly. So I think Macau should have a very clear proposition. They don't want to replace Hong Kong. They just want to be the supplement to Hong Kong. So I think because of their legal system is more because of historical reason, it's more continental laws, not British laws. So I think they may have some unique proposition. And even for the bond market, I think the bond market, we also see a lot of overseas investors or offshore PRC issuers, when they issue offshore bond, they listing in the Macau. I think it's a good initiative. I think we see more and more overseas investors looking at Macau market. And I think we are also see a lot of onshore issuers to look at this market. So I think this is a good trend. I can't say how long it will be a very developed market, but I think it can be faster than you expected. And I think we are also very keen to see how CCDC can participate in this area, because what we represent the onshore 20,000 investors. So I think such kind of northbound stock bond connect, the methodology can also be replicated to Macau. And onshore investor, if they want to invest onshore Macau market, they can also leverage the infrastructure linkage between CCDC and MOX.
Yeah. Next question goes to Qinqin. How far are Chinese banking regulations in accordance with international standards such as Basel III, etc., Also, are there significant differences in the regulatory requirements between private banks and state-owned banks regarding capital and liquidity requirements? Qinqin.
I think the Chinese banks has already been regulated in accordance with the Basel III. As far as I learned from the regulators, they work closely with the Basel III committees. So I don't think it's a question now. With the requirements, private bank and state-owned. Actually, no, the regulatory requirements between private banks and the state-owned banks are the same. But we also call that state-owned banks have more responsibility to help the corporates, to firms. But by the rules, they are the same. So there's no difference.
I think next question goes to all three of our speakers. One, Yi Huiman talks to Caixin, he's chairman of CSRC. He stressed stability in the process of opening up. So our question from the audience and from me is, how about the how to manage the risk of capital flow fluctuations from macro-prudential perspective, and what will you see in the future? Maybe we start from Michael, then Thomas, then Qinqin.
Okay, I think we need to have a three-pair relationship to well balance. I think the first is to balance the onshore and offshore. Previously, when we talk about renminbi internationalization, I think in 10 years ago, we mentioned the offshore renminbi center. But I think more and more, our regulator focus on how to better open the onshore market. So onshore is the leading and offshore is the supplement. So this is such kind of methodology and the roadmap. So when we do some opening up, for example, the bond futures, I think it must be the onshore bond future market open to overseas investor, and then overseas exchange house can list bond futures. So I think this is such kind of roadmap. The second, we need to very carefully balance the convenience and the potential risk management. So I believe not everything overseas investor they request we need to facilitate. So we need to see what's the key risk and what we can do to solve. So we don't need to compromise all the time. So I think we need to focus on the risk management and some bottom line and discipline we need to follow on. And also the third relationship is the self-reliant and also between the self-reliant and open for cooperation. So we want to do independently, but we also welcome overseas participants or overseas market players join with us. So I think we need to very carefully balance these kind of things. From a CSD perspective, of course, we want to do market opening initiative, but we also like to set up our offshore franchise. For example, last year we established our London office, rep office. So I think this is our front line to connect with overseas investors. And also for the risk management, I think CCDC, we have a very, very unique role. We just monitor such kind of risk on behalf of Ministry of Finance, because all the government bonds, central government deposit, we need to see the movement of the price, the bond price. So I think the see-through management, see-through approach, and also I think currently we use the one-tier custodian or depository approach. I think this is also in line with MiFID II, the global standards, the trend of the transparent, the trend of see-through management. So I think this is also what we want to insist. And also for the open for cooperation, we are work closely with Euroclear, Clearstream. We work very close with MOX. with even with offshore exchange house and also London exchange house, FTSE Russell. So we work together with everyone, foreign bank, local bank, you name it. So we would like to have an ecosystem to further develop this market together with all the market participants. So I think this is the sharing from my side. So I think we need to balance the risk and also the convenience.
Yeah, Thomas?
Yes, I also think that it will be a relatively long-term gradual process. So we will see more steps, as already have been highlighted here in the discussion. I think it's also important to understand that if the opening goes too fast, that might actually create some risks. I think if you look at financial history and what happened to Japan or other emerging markets, so if you open up too quickly with having not developed all the institutions and all the frameworks around it, it actually might create some risks and eventually lead to a currency crisis. And I think China has very well studied history, and they do not want to make the same mistakes some other countries have made.
Qinqin, you want some add something or?
I just want to make a little addition. So coincidentally, today marks the 5th anniversary of our foreign exchange reform. So 5 years ago, we launched the reform about foreign exchange.
The 11th, right?
Yeah. And in 2018, PBOC announced that the central bank has already quit the regular intervention of the foreign exchange market. So I think the because I'm covering foreign exchange market as well. So I think the market is the exchange rate is more dependent on the demand and supply, and and the opening up will invite more foreign investors into the market and add more preference and liquidity to the market. So I think the opening up will help the foreign exchange market be more market driven.
Yeah, just the next question also goes to you. Is when China is lifting the upper ceiling for shareholding of financial institutions in China, do you think China needs to foster a bigger or stronger or more competitive flagship brokerage houses or security houses to compete with the international giants?
Yeah, maybe Thomas or Michael can give more additions. So I want to give you one number about this question. So China has a fragmented market of brokers, security houses. We have 131 firms and a limited global presence, but their combined assets equal to what Goldman Sachs sees by itself. So I think it's not a matter of a volume or scope, but the ability of doing business. We have seen that Chinese security houses have improved a lot in the past 5 years, but we have to say that it's still a long way to go for them to be a real giant globally. Yeah.
Maybe Thomas?
Yes, I think basically the market is still relatively fragmented, so it will take time. It will also require some concentration. I think we will see something like we're seeing in every market. So you will have a few global players, but I think expanding globally is difficult, probably also as difficult as it is for Western players to expand in China. So yes, most likely we will have a few global players coming from China, but global players will also be strong in China. You already mentioned a few which already entered the market successfully.
Yeah, so from an international investor perspective, how important is it to be physically in China, as now they are allowing you to come in? How is it key to be the proximity to mainland China? Is it key in your view?
I think it depends a bit. The beauty actually of the Hong Kong market was that everything was available in English and was also very transparent. Of course, now with the Asia markets, information is not available in English, so that makes it a bit more challenging for us, which also makes it more important to have actually people on the ground who talk to other people, other companies on the ground, and who are able to master the language.
Michael, just from the competition perspective.
I think you mentioned the commercial brokers to larger. I think the M&A, the merger can only bring a large conglomerate or large security house, but cannot bring us a very strong, high quality leading real giants, as Qinqin mentioned. So I think we really need to learn from overseas giants like Goldman, like JP Morgan, and for the overseas comingers like who want to set up JV. I also suggest you may also have very clear your China proposition and China strategy. And also another tip is to find a very good local partner. I think China market is very, very different. If you want, now you can set up a fully owned, but if you just send some people, seniors from headquarters, they don't know China. You don't fully leverage local talent. You don't fully trust the local people. It doesn't fly. So I think you need to leverage the local resource, local people, a local partner. So I think China market can really bring your real money or real return. Otherwise, it's just too big to ignore, but nothing will happen.
Yeah, we are already out of time. But before closing, I will have one last question, very short answers expected from all three of our speakers. Just name two things. Name one big thing to watch for the next 12 months and one big thing for the next 5 years for China's financial market. This time we go first to Qinqin, then Michael, then Thomas have the closing.
I think my answers are the same. So for the next 12 months, I think the opening up the market is very important to watch in China. And for the next 5 years, the opening up also is the most important thing to watch in China. But in 5 years, the opening up will be further and deepen. But I think it's still the most important thing in China.
Okay, Michael, please.
I think in the next 12 months, I think everyone for the bond market, you just look at FTSE Russell, their decision whether or not to include China bonds. So I think before that, we expect the regulator will have more gift or more new regulation initiative to happen. So let's see what will happen. I think it will bring also a lot of new good news for us. And in the next 5 years, I think we can see the trend of raising renminbi as the global reserve currency. I think the trend is very obviously. We talk with World Bank. They say after the current coronavirus crisis, more and more central bank and sovereign funds are looking at China bond. Lot of reasons, but they are seriously to review their reserve policy, their reserve risks, especially US dollar continue to enlarge their balance sheet. So I think in the next 5 years, we can see whether the renminbi reserve percentage can raise from now 2% to 5%. And I think it maybe happen in next 5 years.
Thomas, please.
Yes, I think with index inclusion both on the equity but also on the fixed income side and the further increasing of the weights of China will become a major investment destination globally, which you can no longer ignore. Previously, because A shares were not part of the MSCI benchmarks, you could ignore it. Now the weight is still capped, but I think on a 5 to 10 year view horizon, you need to have a China strategy and you need to invest in China.
Okay, yeah, with that, we have to close. Thank you all again for joining today's discussion. And I'm sorry that I could not raise all the questions asked by our audience, but we will have future opportunities, and we can get connected through this network. Thank you again for this for joining this event co-organized by Asia Society Switzerland and Caixin Global Intelligence. See you next time.